Welcome to Talks and Views. In this video we will discuss what is a non-profit organizations, NPOs, hidden AML risks every compliance professional must know. Complete guide.
What is a non-profit organization, NPO? Have you ever wondered why banks sometimes classify charities and NGOs as high-risk customers? After all, they're supposed to help society, not commit financial crime. The reality is that while the vast majority of non-profit organizations carry out genuine humanitarian, educational, healthcare, religious, environmental, and social welfare activities, some have been misused by criminals. Because of this, regulators across the world require banks to conduct enhanced due diligence before onboarding certain NPOs. In today's video, we'll understand what exactly is a non-profit organization, why banks consider some NPOs high risk, compliance requirements during onboarding, major AML red flags, best practices to manage NPO risk. Let's begin.
What is an NPO? A non-profit organization is an entity established to serve public or community interests rather than generate profits for owners or shareholders. Any surplus income is reinvested into achieving its mission. Examples include charities, foundations, religious institutions, educational trusts, environmental organizations, humanitarian relief agencies, medical aid organizations. Unlike commercial businesses, their primary objective is social impact.
Why are NPOs high risk? Although most NPOs are legitimate, they possess characteristics that criminals may attempt to exploit. Some common vulnerabilities include cross-border donations. Funds are frequently transferred internationally, especially to conflict or disaster-affected regions. Cash donations. Large volumes of anonymous cash donations make tracing the original source difficult. Third-party funding. Money often comes from numerous donors across multiple countries. Weak governance. Smaller charities may lack strong internal controls. Beneficial ownership challenges. Sometimes the actual controllers are difficult to identify. Operations in high-risk countries. Activities in sanctioned or conflict regions significantly increase AML and sanctions risks. Potential financial crime risks. Money laundering, terrorist financing, fraud, sanctions evasion, corruption, tax evasion. This doesn't mean every NPO is high risk. Banks should apply a risk-based approach based on the NPO's size, purpose, geography, funding, and governance.
Compliance checklist before onboarding an NPO. Before opening an account, banks should understand the organization thoroughly. Verify registration. Obtain registration certificate, tax exemption documents, government approvals, licensing where applicable. Understand the purpose. Determine why was the organization established? What charitable activities are conducted? Which countries does it operate in? Identify key individuals. Perform KYC on directors, trustees, board members, authorized signatories, senior management. Identify beneficial ownership. Even though NPOs don't have shareholders, banks should identify individuals exercising effective control over the organization. Source of funds. Understand donations, grants, membership fees, government funding, international funding, corporate sponsorships. Source of wealth. For major donors or controllers, banks may need to understand how the wealth was generated.
Expected account activity. Ask. Expected monthly turnover? Countries involved? Typical transaction size? Expected incoming and outgoing payments? Cash usage? Screening. Conduct screening against sanctions lists. Politically exposed persons, PEPs. Adverse media. Internal watch lists. Risk assessment. Finally, assign an appropriate customer risk rating.
Major AML red flags. Compliance professionals should watch for the following warning signs. Unexplained donations from unrelated third parties. Large cash deposits inconsistent with the organization's activities. Frequent transfers to high-risk or sanctioned countries. Rapid movement of funds with little explanation. Complex layering through multiple charities. Reluctance to provide governing documents. Frequent changes in trustees or authorized signatories. Activities inconsistent with the stated charitable purpose. No online presence despite claiming extensive operations. Significant transactions immediately after account opening. Donations received from shell companies. Multiple incoming international transfers followed by immediate outward payments. Whenever these indicators appear, banks should perform enhanced due diligence and escalate where necessary.
Best practices. Managing NPO risk doesn't mean avoiding charities. It means understanding the customer and applying proportionate controls. Best practices. Apply risk-based approach. Conduct customer due diligence. Perform enhanced due diligence for higher-risk NPOs. Verify source of funds. Monitor transactions continuously. Screen against sanctions regularly. Review customer profiles periodically. Understand the organization's governance. Document every decision. Train frontline and compliance staff.
Nonprofit organizations play a critical role in improving society. However, because they can be vulnerable to misuse, financial institutions must balance financial inclusion with robust risk management. If you found this video helpful, don't forget to like, share, and subscribe to Talks Views for more practical insights on compliance, trade finance, supply chain, and blockchain-related contents.
If you are looking for professional training for CDCS, CSDG, CITF, ACAMS, CGSS, CCAS examinations, then you can contact Trade Hunt Management on the contact details appearing on the screen right now.
Like, share and subscribe to Talks Views channel. See you in our next video. Until then, bye for now.